Let's bring in Mark Mahaney, the analyst behind that call. He is the firm's head of internet research. Mark, always great to see you.
Hey, Melissa.
Does this run concern you at all in terms of the speed of it?
Sure. Yes, it does. I continue to like the stock. It's not one of my top picks, but I think there's still upside here, maybe, low double digit, 10% upside. I think there are other stocks that are more attractive risk rewards here. But yeah, I think this, I'll stick with the point, which is I think this is one of the more recessionary resilient stocks you can find. And it's been tested. We've been tracking this for 25 years. And, you've seen Netflix hold up in a lot of economic cycles and different types of cycles over time. So I think that'll be the case here. Also, you got a situation now where they've just hit record high operating margins. And my guess is that they're going to lean into content spend later this year as they really expand the bundle and get it more and more into live sports and make the service more and more compelling. So I think it's recessionary resistant. I think valuation's reasonable, not dramatically compelling, but reasonable. I continue to like the stock.
Mark, you mentioned a lot of good things in terms of them being able to grow top and bottom line. You mentioned the multiple. I kind of want to dig in on the price to sales multiple at 11 times. Can you kind of give us a little bit of background in terms of where that tracks historically? And then where do you think is kind of like the equilibrium point in terms of where you can get comfortable in terms of the multiple that you're paying on revenue?
Yeah, I don't typically look at it on price to sales. One could, but the beauty of Netflix is how it's changed over the last couple of years is, hey, we got free cash flow now. Like we got material amount of free cash flow. They're also buying back stock. They had a record amount of share buybacks this last quarter. Now, I don't know if that's arrogance, stupidity, or what, or just a dramatic amount of confidence because they're buying all-time amount of stock at an all-time high in the stock. That's very bold, but I think they've got good reasons to be bold. I look at it on a PE basis, price to earnings basis. It's expensive. It's trading at like 35 times earnings. That's at the upper end of where it really should trade. So I don't think you got a lot of multiple expansion from here, but the stock can go higher because they're going to be giving you 5% earnings growth. And so that's how it can compound from here. So that's the PE multiple is what I would suggest that you look at instead of the price to sales multiple.